Good morning, everyone. I'm Adam Myers and I lead the distribution team at Pengana. Thank you for joining us for this webinar update with Steve Black, the co-portfolio manager of the Pengana Emerging Companies Fund. To give a quick introduction to those who are less familiar with our business, at Pengana, our key aim is to offer our clients differentiated strategies which add value to their portfolios. We have no Me Too funds in our business. Today, Steve will briefly discuss the consistency of their management style. He will touch on the types of companies they like to own and how this has played out through the recent reporting season. During the presentation, if you have any questions, please enter them in the question box, which is accessed from the icon on the bottom of your screen, and we will get to as many of them as possible in Q&A at the end. Steve, over to you.
So, just as an introduction, this slide just talks through who we are, and the fund, which we started 17 years ago, has been managed with a process and a philosophy that has served us very well over that 17-year period. Ed and I have run this, as I said, for 17 years, generated performance of around 14% per annum after fees, and it's fair to say that that level of performance would not be possible if we didn't have keep a very close eye on capacity of the fund. So as we sit here today, we are at capacity, and we recognise that there are liquidity constraints, particularly in the end of the market we play in small industrial companies. Probably the other takeout from this page is that after witnessing investing through the dot-com boom and bust and GFC and now a pandemic, what that has shown us is that the disciplined investment approach that we run with, which is very conservative, it's one of the reasons we don't invest in resource companies, we don't invest in loss-making companies. It's based around valuing each company's cash flow using a DCF template, and playing the long game in terms of staying fully invested, has served us well through all these those, I guess, shocks to the market. So just reflecting on the last 6 months in particular, just gives you a little bit of a flavour for what's performed for us in a period where we've generated 24% performance after fees, which is around twice benchmark. Some very good contributors there, some underachievers there. This is an active stock picking portfolio, so we will expect to get stocks wrong from time to time, but the blended outcome is still very positive. And it won't surprise you to learn that we've been very active on the company visitation front in the last 6 months with obviously a lot of developments, a lot of news around COVID and the effects that and how that impacts companies we need to learn about. So the journey of 17 years is best illustrated here through the table and chart. Just a couple of call outs. The 1 year number, very strong, around 50% performance, which is circa 20% above benchmark. But consistently over the 17 years, we've also generated very strong outperformance. You can see from the inception numbers. And the benefits of compounding and patience are clearly in evidence here with that chart on the top there, where $100,000 invested at the time that we started the fund would today be worth over $920,000. And just by way of comparison, the small industrials index over that time would have moved to $300,000. So compounding our performance can be very powerful. Coming at it from a slightly different perspective, as I said earlier, we don't invest in the small resources end of the market, which is about 20% of the small ordinaries. And therefore, this internally is how Ed and I would consider the fund and how we've performed. It's against the stocks we choose to invest in, the small industrial companies, and this tracks the level of outperformance against that index after fees. And this time last year, when I showed this chart, I was talking through the fact that we will have, from period to period, some outbreak years in terms of very strong performers. Last year being a good example of that, where we obviously delivered very strong numbers in both a beta and an alpha sense, and this year started well also. But we tend to deliver something close to circa 5% per annum, apart from those outbreak years. So just moving forward to the reporting season just concluded. We've obviously seen a lot of companies. Probably one of the key takeouts for me is just how many moving parts there are for these companies and their businesses, and the drivers of their profitability have been thrown around by those. And that's not just the COVID stimulus that's in the system for their customers, but it's also the macro-driven fiscal and monetary policies of governments. And I truly believe that a lot of management teams are still working through the impacts of that on their business in terms of whether it's actually been a hindrance or helpful to their profits. And for those reasons, I'm not surprised there's been a lot of hesitancy by management to put out profit guidance for the coming 12 months. I suspect there'll be more colour on that through the AGM season that's about to begin. The winners are certainly being well recognised in the marketplace as the vaccination rate is accelerating in Australia. So a lot of the companies providing services, in particular to the travel industry, to the restaurants, those opening trades as they've been coined, their performances in the market, those stocks have performed very, very well. The chart on the right there just talks to our turnover in the fund, and we tend to see about 40 to 50% per annum on average. It was heightened last year because of COVID. And that's a good example of where you want to keep the fund at a relatively low level of funds under management to be able to maneuver in and out of stocks freely without impacting share prices and take advantage of that volatility, which is one of the reasons we feel that we delivered very good outcomes in the last 12 months. Because 12 months earlier, 18 months earlier, we were getting set in stocks that were being sold down indiscriminately during COVID, and we were knowing those businesses and how robust they were. We took advantage of that by buying those stocks for the portfolio. The final comment on this page would be the retail sector. So we have very little exposure to the specialty retail sector in Australia. They're very highly represented in the Small Ordinaries Index. Our concern principally revolves around the fact that last year they had so much demand for their products that have been brought forward because of the fact that a lot of their customers were stuck at home, they were bored, they were given free money, they decided to upgrade their couches, get the 4th or 5th TV in the house. Now that event has occurred. They're not looking for the 6th and 7th TV. So I think demand has been brought forward, and an environment where supply has been elevated due to a lot of these retailers having concerns about supply chain disruptions. We are concerned coming to Christmas and beyond that there won't be enough demand to meet that supply. And so the cost pressures coming through, particularly from freight, for instance, will not be able to be passed on to the consumer like they were last year, which will see some margin squeeze. So despite all that, a lot of those retailers' share prices are trading at all-time highs. So our view is that you are not being rewarded for that risk by buying into those companies. So in terms of our current portfolio and the makeup of the portfolio, you can see there on the right-hand side there a pie chart of rough splits and exposures to various components of the market. And probably one of the key takeouts for me is the defensive component of the portfolio. So these are stocks where their earnings prospects aren't going to be thrown around by the vagaries of the economy, the uncertainties that are out there. They will not be impacted by those, and so we can invest with confidence knowing our valuation has some relative surety compared to some of the other stocks in the index. So that said, we have come through a period where lower bond yields and bond markets have re-rated a lot of long duration assets. So companies that have predictable earnings streams have been re-rated in the marketplace over the last 12 months. It partly talks to our great performance. And we need to realise that as those share prices close in on our target prices, our DCF valuations, that we will recycle that money into other less well-known companies. And that's what has been occurring. So of our top 5 stocks 6 months ago, only one of those now is in our top 10 holdings in our fund, as we've looked to sell down those positions and, as I say, invest in other companies that have more upside. And there's also companies in the fund that we've sold simply because we feel they're over-earning. They've received benefits from COVID. Share price hasn't allowed for those, and that's necessitated us to act also. Corporate activity is on the rise, and I think it's going to really accelerate from here. Balance sheets have been repaired in corporate Australia. Share prices are high, so they've got the currency of their own scrip to use for accretive acquisitions. Private equity have got money burning a hole in their pockets, and we're coming through a period now where due diligence teams can get on and off planes to assess assets. So we would expect corporate activity will really take off from here. This slide here, I won't spend a lot of time on it, other than to say this is probably best thought of as our slide on our investment philosophy. So it's the attributes that we love to find in the stocks that we own in the portfolio. And I can come back to this in Q&A if there's interest, but it is sort of a culmination of a lot of what I was talking about before in terms of our approach to investing. Now, ESG, it's topical and becoming very important to the investment community. We have a policy document online that you can download and read later that is quite fulsome in its explanation. But suffice to say that we have and always had a very strong ethical overlay in terms of the stocks that we like to own. And that's steered us away from a lot of companies that might have shown appeal in terms of valuation upside. We just couldn't bring it upon ourselves to support such companies operating in the industries that they were operating in. And probably the only other comment I'll make here is that we are at a structural advantage in the sense of not investing in the resource stocks. So we're not investing in the fossil fuel industry, which clearly are the probably one of the more dangerous stocks to invest in terms of ESG because of the harmful emissions they release into the environment. And the culmination of all of that is from a bottom-up perspective. That last point is that Morningstar have assessed all small cap fund managers, and they've given us a big tick in the sense that we are in the best quartile in terms of grading and scoring the companies in our portfolio. The IPO market, it's topical in the sense that we are seeing a lot of companies at the moment, companies looking to come to market. For us, it has always, we think, been a poor place to start investing at the point of issue as they enter the market. This table shows you a study from 4 years ago of 80 companies, profitable industrial companies that are in our field of view, delivering an average return of 27%, but the actual median is only 3%. And then similarly in the last 4 years, another 86 companies to the end of August 21, the mean 59%, but the median 6%. And I guess the takeout here is that they sound exciting and there's strong upside, but very few people get access to that upside. If I remove the 4 best IPOs in the last 4 years from that 86, that 59% mean comes all the way back to the median of 6%. So those 4 companies that delivered all that outperformance were really compliance type listings or companies where there was so little stock available that it wasn't realistically a company that we would consider investing for the fund. It was too illiquid. So, and by the way, that's a period over 4 years where the market's up to 30%. So it is a surefire way to underperform if you get involved in every IPO at the start. Our preference is to learn slowly. So we love companies coming to market. It gives us a new opportunity set, another group of companies to consider, but we'll wait, meet management multiple times, allow these companies to register their results to the ASX under their regulatory regime and value those businesses accordingly. And that does unearth some good opportunities. 4 I've listed there, and Aussie Broadband, Unity Group, Johns Lyng Group, Net Wealth, probably 4 of our better performers in the last 2 or 3 years, and they were all IPOs from that cohort of 86 companies. So reflecting on the last 6 months in terms of the portfolio and some changes to the portfolio. So some new icons there in terms of additions, new companies that we've added to the portfolio: Aussie Broadband, Australian Clinical Labs, EBOS, Swoop. Recent purchases are existing stocks which we've topped up in the portfolio. Sales being total sales from the fund in terms of stocks that we've sold in their entirety. Combination of a couple of takeovers there, a couple of companies we felt were over earning due to COVID in Lavisa and Collins Foods, and then the balance companies that are just simply hitting our share price targets with strong performance. And then recent reductions are the stocks that we like and we still own, but we've significantly reduced their position in the fund, particularly with Johns Lyng, Main Freight and Lifestyle, as their share prices have risen. So just to give you a little bit more insight into that line of thinking, Main Freight is a freight forwarding business out of New Zealand. It's a global player, has been an enormous beneficiary of COVID. The share price has reacted. You can see there the green dot has been when we bought this company, and we love this company in every respect. It ticks all those boxes I highlighted earlier in terms of the type of company we like to own, including the fact that they've had continuity of decision making with the same CEO for nearly 20 years. But the share price has just moved too far, and those red dots just highlight where we've been selling down to what is now a relatively small position in the portfolio. The profit growth has been incredibly strong, mostly organic, but in the 22 year, which is the March year end they've guided to, where the company's expecting 50% profit growth at the bottom line, which a lot of which has just simply come because of COVID benefits, which will roll off. Just another area of the market we've recently been involved in is the pathology sector. So two names are Helios and Australian Clinical Labs, clear beneficiaries of COVID in the sense of the PCR testing that they're conducting. We tend to strip out that benefit because it has obviously a degree of uncertainty as to how long or what the longevity of those tests will be. But even stripping out that earnings stream, we can justify holding these companies based on the valuations of their non-COVID testing as the pathology players in the marketplace. The great positioning in the market, repeat business, and that gives us the predictability and confidence in our valuations. And just a quick comment on the PCR testing. Overseas markets would tend to suggest we could well get a lot more testing in PCR sense than the market is expecting. Most of those overseas markets I've shown in this chart here are at least 6 months ahead of us in the vaccination program, yet the testing is continuing at those heightened levels simply because of the need to test people for COVID and isolate them if they have COVID or treat them, but also efficacy of the current vaccine and the need for booster shots, so on and so forth, will lead to a baseline of testing that will continue. The insurance broking sector is a sector we've owned for a long time. Our preferred exposure there is Ausbrokers, but we have exposure across all three businesses. A good test of the sector was indeed through COVID, where there was a bit of stress in the system in terms of SMEs, which are their customers. But the last thing you turn off is the electricity if you're an SME, if you're battling in your business. The second last thing you don't pay is your insurance bill. So through GFC, through COVID, these companies have been proven performers and have very resilient earnings streams. And just the final stock I'll talk to is Hansen Technologies, and it's probably one of our higher conviction stocks in the portfolio. It's a classic example of us as the stock that we think is mispriced because it's not well researched. There's only a couple of stockbrokers that follow it, despite the fact that it's quite a large company. It's delivered 15 years of 15% per annum EPS growth. It'll be the cheapest software company on the market. And what they provide is an enterprise software business where they provide the smarts for the billing engine of utility companies and pay TV companies to bill their customers. So a fully integrated IT solution where you don't lose customers. It's very hard to extract the software. So sticky revenue streams that are predictable, and that's allowed them to grow at that level per annum. And not surprisingly, we had a takeover bid by a private equity firm around 5 or 6 months ago for this company. after polling the market, I think they realised quickly that institutions weren't going to sell to them at what was quite a cheeky takeover price, and so they walked away. And we took advantage of that and actually topped up our positions, and it's now top 5 holding in our fund. And you can see there, just if we lift the bonnet on the company and its earnings, the green bar there is the revenue over time, same management team, same proven business, and the financial year 25 is the guidance from the company in a revenue sense, which is a continuation of around that 15% per annum growth. And then the profits are in with that black line. So the last page I'll leave you with here is just the top 10 holdings in the fund. There's a bit of detail here, so I'm happy to talk through any of those in Q&A. But the two obvious stocks missing would be Lifestyle Communities, which we've spoken about ad nauseum, but it's an incredible business, just fast moving to our share price target, given how the share price has performed, and also Main Freight, no longer in the top 10. They have probably both been in the top 10 for the last 10 years. So with that, Adam, I will stop talking and happy to answer any questions.
Great, Steve, thanks. And we do have a number of questions that have come in. Early on, the first question was, I see Hub24 is in your top 10. Do you also hold Net Wealth?
We do, yeah. So Net Wealth, Hub, Premium, the specialty platform providers, at various times we've owned all those in the portfolio in the last 5 or 6 years. We are favourably exposed towards that sector. For us, it's a very obvious path to prosperity with weakened competitors, legacy platforms that aren't being spent on, and they're from a very low market share, able to grow in a very predictable sense. So Net Wealth would have 4 to 5% only of the total platform space in Australia, been growing at probably 1% per annum. So when we first bought into that 5 years ago, it would have had less than 1% of the market. Now it's 5% of the market, and we would expect that to continue to grow very rapidly. And then Hub is not different at all. It's the same model. In fact, over the last 4 to 5 years, they've onboarded a very similar level of to their platform. Premium's a little different. So Premium we sold out of because it was a little overheated, the share price. It's been speculated that it is an obvious bolt-on acquisition for either Hub or Net Wealth, which saw the share price push up beyond what we thought it was worth. So we disposed totally of that position. So in summary, both stocks are core holdings of the fund. Their share price rise over the last 5 years has meant that they're not as large a position in the portfolio as they were, but we're still very favourably exposed to both.
Great, thank you. Next question, what do you see as being the greatest threats to ongoing profitability and prosperity? What is your response to these threats?
So I assume that question refers to the slide on our philosophy in terms of, and I'll get that up because I know that I brushed over that very quickly. So the point I'm making here is that we meet a lot of companies, a lot of charismatic CEOs, promising the world in terms of what they're looking to achieve, and they're passionate. I get that, and they're exciting opportunities. That's not enough for us, though. We need to see a business that has commercialized a product that's proven that we can value with relative certainty. So in fact, the share prices are rising, and there's that FOMO effect of missing out is something that we're very wary of playing. An example would be the buy now, pay later sector. That's a part of the market where we've never taken an active position in those stocks. They sound exciting, but none of those companies make money. And with competition coming in and with the banks, who knows how they what plays out there. But what I do know is that a lot of success has been capitalised into their share prices already, and they're well brokered. So we prefer to steer clear of that type of thematic. But it comes back principally to the point that without a company making profits, then we find it very difficult under our process to take those companies seriously. And we're spoiled for choice. We've got 800, 900 companies to build a portfolio of 60 stocks from. We don't have to bend the rules in terms of trying to force a company that is unproven into the portfolio.
Great, very comprehensive. Next question, any views on Unity and the potential impacts if Vaughan Bowen will eventually need to step aside?
So Vaughan Bowen is on the board of Unity. So he and his area of expertise is M&A. So first comment is that he's under investigation for some insider trading, but it doesn't relate to Unity. It relates to another stock from years ago. And we've had lengthy conversations with the board and the chairman. One must assume innocence until proven otherwise. But even if he is removed from the board, then we don't think it'll affect the business terribly, because the company for some time now, at least 12 months, has highlighted that it's moved on from the M&A growth angle that it has started with and how it's evolved to more of an organic focus. So I don't think it impacts the long-term value of the company.
Great. Next question, can you please comment on your EML payments holding, given the ongoing issues with the CBOI? I don't know EML payments, but I'm assuming CBOI, sure. The Central Bank of India.
Yeah, that's messy. So it's the Bank of Ireland of investigating them for an acquisition they made that has some questions on money laundering and other concerns. So it's very messy and unfortunate. What I will say is that this is an example of the risks you bear when you invest in companies that have a highly acquisitive business model. And whilst we couldn't pick this occurring, we did become more and more nervous about this company as they were acquiring more of these overseas companies, and wonderful places which you can never wrap your arms around and fully understand the regulatory framework where they have to operate. So it's an example of the problems of acquisition-driven companies. So this stock, we would have had a 2.5% to 3% weighting of the funding 2 years ago, and then we've continued to reduce the weighting as we've got more nervous on their acquisition program overseas, to the point now that it's 0.4% of the fund. It's a tiny position. As I say, we wouldn't have predicted what's played out, but it is nevertheless a symptom, I think, of companies that grow very quickly through acquisition, and they don't. You're never going to know every problem of a company that you're buying through due diligence, and this is an example of that. So it's a tiny position that has had very little impact on our fund.
Great, thank you. The webinar is scheduled for 30 minutes and we have officially run out of time, but I'm going to continue as long as we have questions. So we'll try and get through all the questions. The next question was, do you think there's too much complacency in the market regarding valuations? Historical returns have been very strong.
So certainly it's an interesting question. We always scratch our head on how the market has performed with the pandemic, and it's the very reason why we always are fully invested in the fund, because I think it's a bit of a mug's game trying to attempt to predict market directions. And we've had a horrible number of headlines globally on as it relates to the pandemic, and yet equity markets are obviously going from strength to strength. So the reason for that, though, plain and simple, is that that globally, governments have been very swift to act in terms of stimulus, both from a fiscal and a monetary sense, which has not just stopped business failures and economies staying in recession for long, but it's lowered discount rates that have re-rated growth assets, and that's what's driven share markets higher. With interest rates so low or negative in some parts of the world, there's obviously a real drive to find returning assets, and that's led to the equity markets running hard. So the concern from here clearly is that as there's a tapering of some of that stimulus, or indeed inflation starts to increase, that you'll see bond markets react. You'll see some of the unwinding of that benefit tailwind of lower discount rates for valuations of equities. But as I say, if history is any guide, and I've been investing with professionally for 25 years, is that the timing of that is a bit of a mug's game, and it's you can undo a lot of very good stock picking by just simply getting the one call wrong, and that is the direction of the market. So we'd certainly advocate taking a long-term view, smoothing out the volatility by taking that long-term view, and recognising that you'll benefit from good quality stock picking, and from our perspective, the inefficiency in the marketplace that comes from mispriced securities because they're not well researched.
Great. In the push to zero-cost investment providers, take as an example, do you believe the platform businesses will ultimately be forced into a similar position, and therefore revenues will come under pressure?
So there's been a lot of Me Too's come to market in the specialty platform space, and we've met quite a few of them for that matter. The problem a lot of those companies have is they don't have all the functionality that Hub24 and NetWealth in particular have, and so it is a little hard to compete. And price is never top of the list in terms of why advisors move across to an alternate platform. It's I mean, Westpac had with BT has spent an enormous amount of money trying to protect their legacy FUM, and it's the only bank that's done that, and have largely failed. And they've cut prices, and that didn't help either, because at the end of the day, advisors will receive what they're looking for is a platform that provides them the reporting tools, the analysis tools, to enable their business to operate more cleanly and with their customers. And prices on all the polls, Investor Trends and other groups conduct, has price at number 3 or 4 on the list of importance, and service level is well and truly on the top. So it's just very hard for those smaller groups to compete because they can't actually compete on price. It's not what drives the decision making, and nor can they obviously compete because they're subscale in terms of the R&D and development that those NetWealth and Hub have. They continue to invest in their products. So for us, and the banks have not largely given up, apart from Westpac with Panorama. So I think that for us, it's a very predictable path of prosperity, as that current 4 to 5% of the market that NetWealth Health have and 3% Hub has. We would expect that to move into double digits over the next 4 to 5 years.
Great. Now I'm going to combine a few questions into one. So firstly, do you continue to hold Quickstep? And secondly, there are a few companies that you have showed that haven't performed that well over the last while, Quickstep being one of them. Why do you I'm just trying to get this straight, but is it essentially that you have high conviction in these companies and the market has got it wrong, or is there something else that makes you continue to hold these companies?
So case by case, and we're in the business of taking a risk, and we expect to get stocks wrong. In fact, if in our game, if your strike rate is 6 or 7 out of 10 right, then you'll be top quartile for a very long period in terms of your capability. So Quick Step in particular, it's a carbon fiber business for the aerospace industry, and we had a very small position in that stock, and it's in so small that it's like 30 basis points of the fund. And it had some contracts that were repriced by some of its larger customers. And that was always the concern about that industry, is that they were very reliant on some very large customers, and they didn't have the wherewithal to be able to negotiate with them, and so had to be a margin squeeze. So that led to a change in our model and led to its sale from the portfolio. But case by case, I mean, we still own Amstra, we still own Bill Identity, Pushpay we sold out of the fund as well, just on the belief that it was a COVID beneficiary in terms of the giving space in the US. Churches, instead of putting money in the offering plate, you gave money through an online mobile app, and we thought that got overpriced in the market as people were returning to church in a physical sense. So we did actually sell that, but have owned it for 2 or 3 years. So the changes all the time, and we expect to get stocks wrong from period to period, but the blended outcome is, if history is any guide, is a great outcome for unit holders.
It has been indeed. Next question. You mentioned that you don't invest in mining stocks. Can you give us some examples of some other stocks that you've avoided due to ESG concerns?
Yeah, sure. Another one that just jumps out at me would be cash converters. So cash converters, Ed and I had conducted a lot of work on, and it's probably dating back 6, 7, 8 years ago now, a lot of work on cash converters. We saw a very strong upside in our valuation. But then as part of our due diligence, we visited a couple of stores, and it's fair to say that we were very underwhelmed by how the business model was preying on the vulnerable and gullible, and we could not bring ourselves to investing and supporting in a business that took advantage of those people. So we dropped the file and simply just didn't invest in it. Another would be the gaming sector. So we haven't for a while now been taking meetings from companies that are operating the poker machine industry. Again, I think preying on the wrong people, and we don't want to support that industry.
Thank you. Next question. What's the average PE and yield of your portfolio? Do you have that information at your disposal?
Adam, that might be a question we have to come back to in terms of the quantitative answer to that. What I will, we don't focus a lot on PE and yield because we model companies on cash flow. The PE ratio, it's a profit at a point in time, and that profit at a point in time is not necessarily a reliable gauge as to how that company is performing, because profits can be easily manipulated, cash flow can't. That's why we steer clear of PE-based valuations. But we can come back to that person asking that question later.
Perfect. Thank you. Next question. We have heard a lot about supply chain shortages, particularly overseas, which have resulted in increased demand for second-hand cars. Has that been the same in Australia, and could that have led to car sales over-earning?
So, correct. In Australia, there's been an acute shortage of cars, and no doubt many listeners will be aware of the fact that used cars are very expensive at the moment, and at most measures are probably 30 to 40% above what they were pre-COVID. So that's just simply a supply and demand thematic. As it relates to car sales, it's a little bit more complex because they have a lot of overseas businesses. They generate leads for car dealers, which they get paid for. So on the one hand, if it's easier for a car dealer to sell a car, which it is, then car sales services are in less need, particularly as it relates to their what they call depth products, or the products that they charge a premium for on their website. So we would argue that, if anything, they have been negatively impacted by COVID, and then as supply improves, these car dealers will be in more need for classified type services, which is in effect what car sales are offering online.
Okay, that makes sense. Any comments on the gaming industries and the money laundering, which is in the news at the moment?
No comment, and that's not an area of the market we operate in. So they're top 50 companies. We're ex-top 50.
Cool. And as I understand it, from an ESG perspective, you prefer to avoid the gaming sector as well?
Correct. Yeah.
That makes sense. The question that we're going to end with is a bit of a more light-hearted question. Are there any other investors that you try to learn from or that you admire?
Okay.
I know you've been to the Omaha conference.
I was going to say the cliched answer is Warren Buffett. I mean, you know, that's not an answer though. I'd have gone there, correct, and I'm on a road trip with some friends, but once, just for the experience. But it's, I mean, our process is not overly different to a lot of other small cap managers that have been very successful over the years. It's simply recognizing, and it's not rocket science. We don't have to be the smartest guys in the room. It's just being honest and simple with your understanding of small cap investing, and that is, we are looking at turning over a lot of stones, looking at a lot of companies that other analysts, buy and sell side, aren't looking at, and that's how we unearth our ideas, because they're mispriced, because they're not well researched. So our discipline and our efforts can go rewarded, because we haven't got as many prying eyes looking at the companies that we're researching. And it's not more complex than that. The risk is the bigger risk, and there's a lot of small cap fund managers that have adopted that approach and are proven performers. And that's why I won't single out any one, because it's easy to see in the league tables. The danger, of course, is that through that success, you attract too much money, and all of a sudden it's no longer apples with apples. You're running a different type product, and no longer you're investing in those companies in the $200 to $500 million sweet spot, which are going under researched, and you're investing in companies with $2 billion plus, which most brokers would cover, and a lot of broad Australian equity funds would cover. So it's very hard to find that inefficiency. So it's not a lot more complex than that, to be honest. And then having the passion and the focus to want to meet companies and know how to value those companies is the I guess the secret sauce that allows us to generate alpha. But first and foremost, it's understanding the market you're playing and not raising too much money, and remembering that there's liquidity traps if you do.
Great, thank you. I'm going to wind it up now. Thank you very much for joining us for this update today. Steve and his co-portfolio manager, Ed, have guided the fund to another very strong period of performance. I think it's significant that this was achieved while retaining a defensive portfolio in an environment of uncertainty. What more could you possibly want from your fund managers? Our next webinar in the series will be the same time next Tuesday with James McDonald, who manages the Pengana High Conviction Equities Fund. For those of you who haven't registered, please do so on our website, pengana.com. If you have any other questions, please get in touch. We'd love to hear from you.